Hey, everybody, this is Matt Ryan from Revive. If you want to learn how to use your small axe to build an empire, you should be listening to the Small Axe Podcast with Nico.
Hey guys, it's your boy Nico here from the Small Axe Podcast. I want to show you how to use your small axe to build a lasting empire. You see, not everybody begins their investing career with millions of dollars, a huge network of investors, or the knowledge necessary to become successful in this space, and that's okay. What I focus on here on this podcast is helping you hone your skills, sharpen your tools to become the best investor that you can be. Now, I want you to sit back, relax, and enjoy this show. If you have any questions or you want to reach out to me or the guest, feel free to do so. Love you guys. Okay, Small Axe community, it's your boy Nico, and I'm back, and I'm hanging out with this cool guy, Matt Ryan. He's over on the West Coast. I'm on the East Coast. We just kind of met, and I was talking to him prior to getting him on air, and he's a really cool guy. If you're watching the video, you can see that he plays some music, he surfs, just like me. So I'm excited to get to know him, and I'm excited for you guys to get a taste of what he's up to, because he's up to some really cool stuff. So, Matt, welcome to the show.
Thanks for having me.
Yeah. So, you and I spoke offline and I learned a little bit about you, but maybe you can kind of take a few minutes to walk the listeners through how you got to where you are today.
Yeah, absolutely. It was around, I want to say 2009, 2010, the recession that I decided that I didn't want to work for my family's business anymore. And I wanted a career, not a job. Right. So at the time, had a little bit of a colossal freak out, as most of those kids in their mid-20s do sometimes. And, I ended up stumbling into the energy efficiency and green building world at the time. I was passionate about the environment, but really felt that for-profit solutions, market solutions were the way, not just kind of working. I got involved with some nonprofits, and I appreciate the work that they did, but I was kind of about solving problems. I read a case study that a reduction of 3% in the statewide energy consumption in my home state of South Carolina would actually mitigate the need for a controversial coal plant. And I thought to myself, like, 3%, come on, like this should be easy, right? Mm-hmm. So at the time, Secretary Chu, Obama, American Recovery Reinvestment Act, they saw the retrofitting of existing buildings, which consume 40% of the energy and, subsequent amount of carbon and environmental impact, as a way to kind of revitalize this workforce that had been decimated during the 09 recession. And so I dove into that industry with, as many people did, with broad ambitions. We broke profitability in the third year. We tried to scale. We tried to raise capital, albeit kind of unsuccessfully. And it was around that time that I bought my first investment property in 2013. And for $95,000, or excuse me, for $65,000, I put 30 into it, rented it up. I joke with people, I rented it before I even got the lights turned on, and my buddies made fun of me for that, even though the people signed the lease the next day. And so it implemented what I knew, right? And around that time, again, I was looking for another career. I knew I wanted to be an entrepreneur, and I know I wanted to raise capital and continue to start businesses. And so I spent about 60 days here in San Francisco. I met with someone who had tried to raise capital, for the type of business that I was previously in. He kind of laid it out for me. There wasn't a lot of promise left in that industry. It had a lot of headwinds. And so I said, what's the best way for me to kind of parlay my experience and knowledge of construction and all the things that I've learned, and find a career again, right? And so I doubled down, and it was around that time that I met a community member in my neighborhood that I bought my investment property, called Miss Pam. And she inspired me, and it essentially inspired the idea of Revive, which is, how do we revitalize communities while also paying attention to maintaining existing community members, specifically low-income members like herself, who rent and, took the bus to her second job at night, walked to school every day, had those community amenities that a lot of people are seeking. But, understanding and through my studies in sustainable building and energy efficiency, I knew how important it was for people to be able to attain housing in these walkable, bikeable areas with good access to public transit, especially middle income people. And so, that was really important to me. And I just kind of took that experience and parlayed it into real estate investment full time. And just started in 2016.
Wow, man, this is a really cool journey that you're taking us on.
and very noble, right? Because you're doing things that are beneficial for society, for the environment, not just yourself. And I really love that outlook. And I too, would love to go that route. Although my journey is still just beginning as well. So let's
Yeah.
talk a little bit about those. So you mentioned in there before I jump forward, you mentioned in there something about kind of failing. Is that what happened on the first acquisition?
No, the first acquisition actually went extremely well. We ended up, once I moved here, I was kind of like, what do I do next? And it was actually a family member. He was like, why don't you sell that building? Why don't you put it on the market? And so I did exactly that. I was making like a 13% cash on cash, but it was only about 14, 15 grand a year, which was good money for me, supplement
Mm,
that with a small business owner that I was cash flowing. Like I could have continued to do well. But I sold it. I 1031'd it into an industrial building that actually my family had an option to purchase. So they turned around and leased it back from me. It was a pretty sweet deal. And, off to the races. Like it provided enough cash flow for me to start bootstrapping my company again. I pulled a little bit of that equity off to the side, some cash, and also, had a condo that I had sold and made a decent profit on. So I had already kind of toyed with real estate, as a little bit of a side hustle. I house hacked before I knew what house hacking was. Bought a foreclosed that condo that I mentioned was a short sale in Charlotte that I then rented to friends. Got a roommate and all that fun stuff. And so, no, I mean, I was kind of shucking and jiving in real estate, and that duplex was really kind of the thing. I mean, I doubled my money in 2.5 years, so that was killer, and that was when the light bulb went off. I'm like, wow, this is when you do it right, this is really powerful. Pick the right neighborhood, the right asset, all that stuff. So
all right, awesome. So now what time frame are we in now? Are we getting towards 2016-ish, or when did you begin this?
yeah, yeah,
Yeah.
that was about 2016, 2017. Yeah, and then we did our first value add acquisition in 2018. It was a little 11 unit building in Sacramento. And we instituted our first value add strategy there, where we tried to focus on a tenant retention model. We sourced it off market directly from an owner, which is also kind of our general part of our business plan. We saw that as a viable, means of acquiring assets, especially at a discount. And so, we bought it direct from the owner, executed value add strategy, and we're able to keep some of the tenants by kind of coming up with an innovative model that focused on maintaining them, where they sign a lease for 2 years, we make nominal upgrades. The building needed a ton of work. Of course, not everyone took it, but we try to really be cognizant of the fact that, we were displacing people when we did that. So we really kind of put that forward, and we wanted to grow and scale that model with the idea that we could kind of create a unique mechanism for value add investing, because I still see that as a really key problem that we have in real estate, right? Value add investing is creating displacement. It is pushing people out of homes, sometimes with good reasons, sometimes with bad reasons. That's really to be argued in another context and another conversation. But it is an area that I think from a real estate perspective, we need to focus on creating the right incentives versus the incorrect mandates. And that was a place where I really felt it was pertinent when you're looking at this large, broader thing of community revitalization that I wanted to focus on. Subsequently, we ended up kind of abandoning that strategy because Sacramento and California passed rent control more broadly, which again, we're just not proponents of. Again, we're against mandates. We're more kind of pro incentive, find a way to incentivize people like myself who want to do the right thing and provide affordable housing for people, but also need to make those necessary capital upgrades, who need to have a means of evicting a tenant who's not paying rent, And what we've seen here in California is a lot of the rent control laws actually just make it almost nearly impossible for a tenant who's a bad actor, to get them out. And then everyone kind of, frankly, it's not just the owners, it's the tenants that kind of pay as well, because when owners get behind on rent, they quit investing in their buildings, because they don't have the capital to do so. And so, anyways.
Yeah. Really interesting, man. So I live in New York, and there's rent control here as well. And one of my friends is a property manager here in New York City, and he mentioned to me, like in all these trendy areas of Brooklyn, and where there is rent control, and there's just not enough money to sustain these buildings and continue to rehab them or even upkeep them. So like he gave me an example, like they had to rip out all the cabinets. These things were like 50, 60-year-old cabinets that they had to rip out. They couldn't afford to put new ones in. So they ended up just putting like this open shelving system, which is actually very trendy. And it's just like, 2x6s that they,
Yeah.
so instead of having kitchen, cabinets, they have like 2x6s that they just stack, or whatever, 2x8s, whatever it is that they stack their plates on. And it's a kind of trendy, but it's a reality of what's going on. The landlords can't afford to upkeep and maintain their properties properly.
Yeah, well, especially in places like New York, the reason is because they've not allowed you to pass through those expenditures to the tenants. You have to eat them, you have to absorb them. And the other problem is that the rent escalation caps that they put oftentimes don't really trend in the direction of inflation, right? And if you look at it, they're supposed to, but for what people are paying versus the labor rates to repair and maintain a property, replace cabinets, upgrade plumbing, it's completely. I mean, you look at it in San Francisco, there's no way, and so it's really, yeah, it's unfortunate that exactly that's happening, right? People are just continuing to disinvest or not invest, and that slows down the growth of jobs, right? Contractors, and we're facing a labor shortage, of course, now at this point. But frankly, we would have even more production, right? If we just protect those tenants, right? It's not good for society, and it's not good for our business for people to just go in there and kick people out, and use impermissible reasons like, fixing a light bulb or a water leak to get someone out to push up rents. That's definitely bad behavior that needs to be addressed. But we've definitely overcorrected, and the broader academic community agrees rent control is not an effective means of actually doing what it said. As a matter of fact, 3 to 4 of the most expensive markets in the country are actually rent controlled markets. So by theory, if rent control worked, how are those markets the most expensive? And not just the most expensive, but the most expensive by a long shot.
Wow, man. Awesome conversation. And we could really, really touch on this. And it's just at least important for people to note that rent control, and I think you summed that up pretty well, that rent control doesn't necessarily effectively solve the problem that is at hand. All right. So, Matt, where to next? You got that 11 unit in Sacramento. What happened after that?
Yeah, we decided to pivot into co-living because it generally matched our thesis of addressing missing middle housing, focusing on, this larger problem of community revitalization. How do we balance old and new, right? And from our perspective, what's happening is these mispams are generally getting misplaced. Older tenants who've been in the neighborhood for many years, probably renters, don't own. They're getting misplaced by younger people who are moving into these neighborhoods seeking affordable housing, because also young people happen to be some of the most rent burdened individuals in society. A 25-year-old oftentimes pays up to 45% of their income to rent. That is, you're considered rent burden, at 32 to 34% of your income. So these people are struggling to get by, and they're competing with these older people and these lower income people for low density housing in up and coming neighborhoods close to urban cores. We saw co-living as an opportunity to be able to quickly deliver product that would reduce competition for those people between those two groups, right? So that the 22 to 35 has a house that was normally maybe a 3 or 4 bedroom house is now 20 bedrooms, and they're sharing some common space together where they can get an affordable place to rent, and they're not competing on the housing with the Miss Pams, right? Because the other problem that we have is that we're not only not building enough housing, but we're not building housing across the variety of stock because our zoning codes are antiquated, and it's not conducive to build a 30-unit apartment building. You can only afford to build 80 to 100 now, right? And you only can afford to build Class A, they call it luxury apartments. Well, the problem is builders would build more of the low-income apartments if we could generate enough supply, right, to be affordable to those people, but we can't because of regulatory barriers. So we liked co-living simply because we felt it addressed the larger thesis of community revitalization. It provided an affordable rent without a subsidy. We're not low-income housing tax credit. We're not Section 8 vouchers. Just it's what we consider affordable by design, which we're stealing from a local developer who actually trademarks it, Panoramic Interest. And they build micro apartments. So, effectively, the co-living strategy we were very bullish on. We also saw an upward trend. It's been a well-established market in Europe for decades. It's frankly been a well-established market here in the US. It's just never been monetized by sophisticated operators and developers and provided in a way that's very frictionless, right? Where normally you go on a Craigslist, you do a roommate share, you bounce around to a few awkward interviews. It's unsophisticated. It's a buddy or a friend or a young person who's managing it, right? And now all of a sudden you got to figure out, well, how are we going to split utilities? Who's going to furnish it? Who's going to take out the garbage? All those things. So co-living operators, in the last, call it 8 to 10 years, have stepped in and basically optimize, excuse me, or a lot of that operating model for young people and made it a very frictionless, Common being one of the largest. And, again, proof of concept that this market's getting ready to explode. The UK has an operator, Cohabs. They just raised $450 million from venture capitalists to expand their market in the US. And so small scale co-living has kind of been a core element of what we've been doing. We have projects now in Sacramento and Denver, 40 units coming online. We're looking to scale up and grow to 100 units in our prospective markets in Denver and Sacramento, expand to other geographies, and also just working on ground up development as well. Because really, purpose-built kind of co-living versus trying to convert an existing building, it's inherently complex. We've had a lot of success converting office buildings that were previously residential back to residential for co-living, but those deals are really kind of far and few between.
Whoa, Matt, you're blowing my mind here, man. So, kind of embarrassingly, I wasn't 100% familiar on co-living. I'm still not clear on it, and I'm glad we're having this conversation. I will also, after this conversation, I would love to touch on the micro apartments that you're talking about as well. But let's stick with this for now. So you answered some of my questions in there, like because you can buy an existing building and and convert it, right? Or you can build from the ground up. However, are there also a third option of already existing co-living spaces that you can just purchase?
Yes, but you would be really hard pressed to find them, honestly, until a few of the operators, call it property management companies that had started to develop some of their own sites, kind of went away during COVID. It was very hard to actually purchase an existing co-living property, right? We're still very much at the kind of innovation stage, early adoption stage of this cycle, or this industry, I would say.
Okay. Now, how is it different from student housing?
It's really not different, other than that you're sharing common areas, and that I would consider student housing oftentimes being done where a developer is maybe doing it as on a fee base for the university, or it's being privately developed, right? But those people still aren't necessarily furnishing the common areas and people are renting a bedroom. They're still renting a studio or a 3 or 4 bedroom apartment, right? And someone's putting up the deposit for that.
Okay. And you mentioned in there, so let's say we have, or maybe you can even give us a case study of what you currently have, but a co-living complex. I don't even know what to call it. And is there a certain ratio of bedrooms or space, square footage for people and amenities, and what does the design look like?
Yeah, absolutely. So the thing that excites us is, kind of within the same context of Revive, of community revitalization, is I've always been fascinated and enjoyed the idea of renovating old historic structures. And that was actually, before I got into the development side, I really thought about just starting a general contracting firm to focus only on historical landmark buildings, because I've always just been fascinated by them. So lo and behold, my first 2 projects in Denver and Sacramento, again, previously commercial offices, one's 4,500 square feet, one of them's 8,400 square feet. We're converting them back to residential. So there will be between 4 to 6 bedrooms per dwelling unit. So those 4 to 6 individuals will share a common living, kitchen, dining room. Okay. Some of those individuals will actually have ensuite baths, so they won't have to share a bathroom, and then some of them will. And that's where you get your little diversity of unit mix. Okay. We will furnish the common areas. They will bring their individual furniture. Some of the bedrooms we are looking to potentially furnish as well with bedrooms and small composition of furniture. Just by recommendation of our, some of the operating teams that we're looking to pair up with right now. But that's pretty much the gist of it. I mean, we do biweekly cleanings, utilities are included. Again, a very frictionless move in, move out process. And, that's pretty much it.
Now, you mentioned when you were first explaining this, Something about splitting up the utilities and the costs of living and inhabiting a place. How does that work?
Yeah, I mean, that's more in reference to where if you went on like a Craigslist roommate share, you're moving to a new city, which is actually fairly common, if you go to New York, San Francisco, you probably approach that, that way of seeking housing because it can be really hard to find a 1 and 2 bedroom and it's really, really expensive. So that's more in the context of like if you're going to go out in a Craigslist roommate share, those are the problems that those people faced, right? It's kind of awkward as to how those things are divvied up, who's responsible. It's not those places aren't typically professionally managed. It's someone who was able to afford to put the big deposit down on a 4 or 5 bedroom or a group of people, and then they split those things, right? But it's fairly disorganized. So sometimes it works really well, right? But for us, we always saw, and the market has continued to see, another crop of people who are like, hey, I kind of want professional management. And not only that, but you may be someone new coming to a city, and so you being able to do it very seamlessly, right? Or even bring a friend versus trying to go out and do it on your own and working with a professional property management company that can expedite all that for it and make it easy for you.
Okay, okay. I think my question maybe was more, well, thank you for clarifying, but I think I'm trying to get to is it like, is each room individually metered, or is there a rub system, or how are you
Oh, yeah.
collecting?
Yeah, we just do a flat fee for utilities and then we handle
Okay,
the utilities.
gotcha. Okay, awesome. And is there like so you're doing this in Denver, you're doing it in where else?
Sacramento.
Sacramento. So are there certain cities that are more I guess popular for this type of living?
Yeah, I mean, for us, we also, as part of our general thesis, we like to focus on primary and secondary markets and then specific neighborhoods within those markets that are the next kind of up and coming hot neighborhood. Generally speaking, the markets have strong job growth numbers, strong rent growth numbers. I mean, both those markets have been in the top 10 for rent growth conditionally over the last 5 to 7 years. Yeah, and we look for a continual influx of 22 to 35-year-olds. We've seen that in Sacramento. We've definitely seen that in Denver. I mean, Denver's had crazy amount of inventory hit, and they're still absorbing it just at an incredible pace, right? We've seen a lot of young people move there. So that's kind of the general conditions for us when we look at a market. And obviously, the other kind of core fundamentals like the continual growth in average area median income, which a lot of those young professionals are helping to kind of bring up.
Beautiful. I got you. I got you. I'm loving this, man. Really interesting stuff. So, is there like, let's talk about profitability for us as operators, but also for the renters. Not profitability, affordability for the renters, and profitability for the operators. Is it similar to multifamily or another asset class, or is it different, and how? And then for the renters, I mean, you're cutting them. We have to get them in there, right? They need a place to live. You're talking about like 23 to 35-year-olds. I love that you have the demographic picked out. And how does it help them?
Yeah, that's a great question. So the cool thing is that we're basically delivering, it wouldn't be considered a class A product because it doesn't have amenities. There's not a gym, right? These are smaller individual assets. Again, 10 to 20 beds. But the cool thing is we're able to deliver a product with rents at the bottom 15% of the market, right? So what does that mean for the tenant? It means in Sacramento, if studio rents are $1,850, we're actually going to go out there and market at $1,200 a bedroom with $50 for utilities. So that's a pretty significant savings, right? Almost $600 a month. In Denver, same thing. We're seeing studios 15, 1600, sometimes even into the twos, right? And we're offering rents basically at $1,200 with a $50 utility expense. Okay. And so again, you're seeing differences of anywhere between $350 to almost $650 a month if they were to go out and rent a studio on their own and live by themselves, or renting in a co-living. So substantial savings over time. What does that get us on the developer on the back end? Well, we're getting a higher density, right, than you would traditionally would with a multifamily building. And so at the end of the day, not only do you get a net operating premium, somewhere in the neighborhood of anywhere between 15, we've seen as high as 35%. But you're also seeing, excuse me, on the development side, say a 50 to 75 basis points jump, on the value of your building at the end of the day. Now, the problem with co-living and the thing that's happening right now is the debt markets have frozen on it. So they're not acknowledging that extra profitability because of, the appraisal process. And, sometimes they can't even believe it. I was talking with an operator who's doing stuff in New York, and they're developing an asset in Denver. And they said, our banks, they almost can't believe that we're making this high of a rent per square foot, that we're getting this NOI. So they're very trepidatious to allow us, to recap and pull that money out. They want to see it over the long term. So there's this interesting imbalance right now where these buildings are more profitable, they are outperforming, but the banks are very leery about acknowledging that profitability yet until there's more movement in the market and more, use cases. And so that's for us, an exciting thing that we see as developers is like, let's build a great portfolio. When in time, once that profitability is acknowledged, these buildings are going to far exceed the value of their peers, in the multifamily space. So, and again, we're able to rip off a cash flow in a market where if you were buying a value add B asset, you may not cash flow, and that's the other beauty is that we've always wanted, as an investor, I always want that good, at least a 4 to 6% cash on cash. And we want a 14 to 18%, ROI or IRR on the long term. To me, that's middle of the fairway. That's the solid stuff I like to invest in. And in these markets, especially pre-interest rate, even now, it was really challenging to get any sort of cash flow out of a value add deal. And we're able to get that, because of our rent per square foot and NOI premiums.
Oh, Matt, you're answering my questions as we're talking. I love it. I was thinking exactly that when you were speaking, because historically, I'm not sure. Well, I can't even say historically because I'm thinking Airbnb stuff, which is different. But Fannie Freddie won't touch it because maybe it's just too new or whatever. I don't know.
But Fannie and Freddie were really close, and I got to give props, to one of our guys there, and he was, God, of course I'm got to give him props, and I'm drawing a blank. It'll come to me in a second. But he was actually working with Fannie and Freddie, and they were really close to carving out a product for this. Adam Dosky, he formerly of CBRE, now at Berkadia, and we touched base during the pandemic, and he's like, they've pulled back a little bit. I don't know where he's with it now, but they were definitely starting to get on board. And of course, once institutional debt comes on, it's like, it's game on for sure. So
awesome, man. So I'll just keep this quick. But how are you currently funding? Are you using bridge debt? Are you using local banks? What are you using?
Regional banks basically is what we're utilizing right now for both construction and the perm financing.
Beautiful. All right. So as you were talking, I typed in a couple of questions so I don't forget, because these are great questions and this is a cool conversation. So we mentioned there are, limited amenities more or less, but what type of amenities are important to this investor or to this tenant base?
Yeah, it's funny, as we're interviewing potential operators, at the end of the day, the general feedback is people still want a well-maintained building. They want maintenance, request fulfilled, right? The biweekly cleaning service, those are things that have to be integrated. On top of that, we've heard people doing things like dinners, monthly dinners, events, bringing in vendors, that they'll pre-negotiate discounts for. Those are all things that we're looking at. The first thing that we want to do is we want to be an efficient property manager, which is really challenging to do. Those other things, building an essence of community starts with people feeling like their needs are being met, right? And that the building, that the owners care about the building and the maintenance of the building and taking care of the issues for people. And as much as there's a talk about a building of community and co-living, which there is a lot of truth to that, and it's really important. That's the foundation, right? Beyond that, like I said, biweekly cleaning service, other community events, cookout, stuff like that the operators will kind of put together a little kiddie fund for people, and throw that out there so people can interact, stay collectively, engaged, right? It's difficult sometimes when you're all living together and sharing common areas. And also just dispute resolution, staying very on top of that, really staying engaged with people, having community managers on site who are getting ahead of issues between existing tenants, and even allowing people to conduct interviews of prospective tenants to make sure that it's a fit. We're not just placing anyone in there who's meets the qualifications on a financial basis. It's like, you need to go in, meet these people, make sure that it's a fit there. And so it is a little bit more challenging on operating model at times, but it's, at the end of the day, it works, right? Because obviously people feel like they have buy-in. They feel like people care. There's an operator there that's staying on top of issues, and making sure that it's a livable, environment for people. And I think that's, that's the core of it too.
Awesome, Ryan. Man. Okay, next question on this same kind of topic. How many people can live in one room?
Yeah, they allow couples, and there's an upcharge for that with previous operators that we've discussed. I think we'll probably implement the same model where it's no more than two people. Yeah, we're not, some people will do co-living, and then they've done like what they call pods, where you're taking a room and then building bunk beds and stuff like that. It's not really, that's not really what we're into. I know it works for some people, and for some people who are really stretched financially thin, they're happy to have that. It's not our particular model. So two's pretty much the max.
Cool. All right. And is this the same as the micro apartments? Is that what they're called?
So yeah, so micro apartments is kind of a, excuse me, a step up. So a room would, in a micro apartment, maybe have its little own kitchenette with a hot plate, with a microwave, with a small refrigerator. So it's adding a little bit more amenities, maybe a little kitchenette with a sink, so that people don't have to go into the common areas, but then they'll still have shared common areas as well. And then sometimes they'll often have modular, like some of the micro apartments we've seen are having built-in modular furniture, where you can make a 350, 400 square foot space feel really big, right? You're seeing that come online. That's kind of the general, build out of what we're seeing in micro apartments. And then like I said, the friends that we have, they're getting ready to do a micro apartment development in Denver, and it's going to be one of the first modular projects for micro in Denver. So they'll literally be sliding it into a box pre-built, pre-manufactured with the furniture, which is really cool. So that's kind of what you're seeing on the micro apartment side of things. It's just a slight, variation, and every room has its own bathroom versus there's some, unit mix in ours that people still share a bathroom.
Gotcha. But they might share some other amenities where they do have typically they could have a hot plate or some small type of kitchenette inside. Cool. Matt, all right. What are you currently working on? What deals do you have going?
Yeah, so we are stabilizing, again, some of the existing assets that we're currently building out in our portfolio, but we are raising equity right now, both on a syndication and potentially a fund basis, but right now on a deal by deal basis, but with soft commits for ground up development. And then we have I just looked the other day, we have about 180 beds of potential targets for existing office buildings in Denver that we're going to start hacking away at, and hopefully, many more in the pipeline. To kind of ramp up and continue our, again, the growth of 100 beds in each market. We're about to deliver 40 right now. We want to keep growing and meet that need. So, that's what we're up to right now. Again, actively raising equity for people who are interested in the industry.
I love this. Before I ask my next question, are there any specific tax incentives for you as an operator and or the investors that might be different from a traditional multifamily?
Nothing other than what's traditional. We do cost seg studies on ours. So for those who are eligible, on the development side of things, especially if it's a heavy value add project, there's going to be substantial tax benefits there. We've tried to pair co-living, purchasing existing assets in opportunity zones. Unfortunately, deal flow, because it's, finding an existing asset that can be converted is hard enough. Trying to do an opportunity zone was even more challenging. We're still open to that. We're very familiar with the ozone legislation. We launched a mini fund in 2019, but unfortunately, we just couldn't get those two things to pair together at the time, right? But we're still very familiar with that and open to it. So those are probably the two main ones right now.
Awesome. Okay, so now, so you have a fund going or a syndication going right now that people can invest into, correct? And maybe you can kind of go over a little bit about what returns look like and projections, and or where, if you have a specific property targeted or if you have something planned.
Yeah, so we have a small allocation that we've kept open for our G Street deal in Sacramento that's currently under construction. We're due to deliver that in the next 8 to 9 months. So people can still get into that deal. We've kept that open because we're still a young company building out a base of retail LPs. It's important to us that we do that. And then, as far as the syndication, it will be a deal by deal basis. We work at it like a semi-blind pool where we basically get a soft commit letter from people who buy into the industry and what we're trying to do. And then it's very much in just building that relationship with the investor that, hey, we're going to go out and source deals on your behalf. When it's time, you're comfortable with these things, you feel good with the returns, and you're giving us our soft commit that when we bring you a deal that you're going to invest, right? Not anything that's new for those of the people who've done syndications. Again, trying to get a fund going in time, but that's a lot of work. We don't know if we're quite there yet and ready to take that on. So right now, everything will be on a deal by deal basis. And as far as our underwriting, here's the thing, and this is I'm struggling with as a new operator, or 7 years, but still kind of a new by many people's standards. We underwrite conservatively. 4 to 6% cash on cash, 14 to 18% ROI is what we underwrite to on a 5-year hold. 2x equity multiple, 8% pref, 70-30 split. It's vanilla as hell, right? And I always tell people, I'm not here to sit here and tell you we're going to hit a 22% IRR. Okay. 2.1 million invested, maybe a little bit more, 2 million in private debt that I've raised that I paid a flat 8% on that equity. I've hit a 27% internal rate of return over 7 years. Not a bad track record. Am I going to sustain that forever? Probably not. If I can land in the low 20s to high teens, like every other fund manager out there, I'll be really excited. That's doubling the S&P 500 historically, right? And so what we try to do is just tell people where we embed and where we're conservative on our underwriting and how we're going to underpromise and overdeliver. And that's all we focus on. As a young shop, we try not to get hung up on, touting higher RR projects. Every deal we look at, we try to underwrite to that basis. And then we talk about it with our investors as to why we think we're going to beat it and why we're going to exceed it. And we've done that historically by being extremely conservative on our refinance rate, on our loan to cost on our refinance. We typically don't trend out our rent growth. So whatever we underwrite the day that we're pro forming it, we don't look for rent growth, even though there may be a year or two of rent growth embedded in there. So we're very conservative on our rents there. We've thought we were traditionally conservative on our construction budgets. That's always a surprise. But those are kind of 3 key things, and then we do the standard, 2% growth on rent when these markets are ripping 6 and 8, and we underwrite high vacancy rates, and some of these markets are outperforming 6 to 8, 9% rent growth a year. We're still performing 2, so there's a lot of meat. If you look at that and you start plugging those things in a pro forma, gosh, you can go from, a 15 to a 30 overnight. And you can make it look even better with a quick 3-year exit, right? But we're looking at the long term. We're looking conservative again, under promise, over deliver. That's pretty much what we're trying to establish ourselves reputationally as a firm.
Matt, I love it, man. This is really, really inspiring, interesting, and I want to get involved as well. So I am thinking that my listeners are also going to want to get involved. So let's give them, before we get to my final question, like I normally do, let's give them some form of reaching out to you ASAP if they want to get involved in your current deal, or even just get to know you, learn a little bit more, and kind of connect with you.
Yeah, so it's really easy. Go to revive.com. The homepage there's a link. You can schedule a Calendly link with me. My assistant will reach out on my behalf, get a little bit of information from you, understand a little bit about you as a person, as a potential investor, and we'll set a time and talk. And it's usually about a 15-20 minute phone call as an introduction. And we'll kind of cover what your objectives and goals are. And, we'll see if what we have is a good fit for you. And if not, we'll try to provide you the resources and tools to get you where you need to go. And that's pretty much it.
Oh man, see, Matt, this is the way life works. I love it. This is who I want to do business with, people like you. So thank you so much for your time today, man. Let's do this. Let's do our final question. See how you handle that, because it's a doozy, man. All right, man, let's imagine it was 100 years from now. You have great grandchildren. They are super happy, and they wanted to write a book about you to honor you and your life. What would you want them to title this book?
Yeah, that's a tough one, man. Wow. I think I'll default to a kind of a made up quote that I came up with a long time ago that I think kind of fits me as a person and just kind of my life. It's speak your mind, live your dreams, and embrace the ones you love. And I don't know, I think that would pretty much encapsulate what I would want to be remembered for, and kind of how I live my life, I think in a nutshell. So.
Oh man, I love that. I want to rip that off and duplicate that.
Hey man, it's yours. Yeah, sure. Take it. You just got to give me credit, right? You got to now my name has to go at the bottom of that quote, right? So.
Beautiful, Matt. Thank you so much. So I honestly learned so much from you today. I'm really inspired, like I said prior, and I love what you're doing. I can't wait to continue talking with you. I'm excited we just connected, and now let's keep talking, man. So thank you so much.
It's my pleasure. Thanks so much for having me. I really appreciate it.
All right, that is technically the end, Matt. That was awesome. I loved it. I really, really did. So thank you.
All right. Hey, Small Axe community. I would like to say thank you for listening to another episode of my podcast where we show you how to use your small axe to build a lasting empire. Now, if you liked what you heard, it would mean the world to me if you would subscribe, leave a 5-star rating, and write a review. Also, if you want to get in touch with me, go to my website at smalaxecommunities.com. Book a call with me. And until the next episode, keep sharpening those axes.